I learned long ago that the market has no mercy for enthusiasm. It doesn't care how convinced you are that a stock is ready to explode. It doesn't care how much time you've spent studying charts or how much confidence you've built from your last win. The market rewards only one thing: proof. Proof that the move you're anticipating has already begun. That's why I say, don't buy breakouts without proof. Every young trader falls for the same trap. You see a stock climbing toward its previous high. Your pulse quickens, and you start thinking, this is it. This is the big one. You imagine yourself catching the move right at the beginning, like a hero who spotted the opportunity before anyone else. But what you forget is that everyone else is seeing the same chart. The smart operators, the insiders, the professionals, they're watching that same resistance level, and many of them are waiting to trap you there. A breakout without proof is nothing more than a rumor on a chart. A few upticks don't make a trend. It might look convincing, but the market is full of false signals designed to test your discipline. I learned this the hard way more than once. In my early days, I used to jump into every apparent breakout as if it were a sure thing. I was fast, impulsive, and overconfident. Sometimes I'd win, but most times I'd lose because I mistook movement for confirmation. Here's something the market taught me: the best trades don't need to be chased. If it's truly a move worth your money, it will prove itself. There's always a second chance to get in. A real breakout sustains itself because it has genuine demand behind it. A false one collapses the moment the crowd realizes they've been fooled. Now let me tell you what proof means. Proof is not just a price print above resistance, it's the behavior of the stock once it crosses that line. Does it hold above that level? Do the volumes expand in a steady, healthy way? Do the reactions, the pullbacks, stay shallow? That's proof. It's the difference between a move supported by professional money and one driven by emotional amateurs. When professionals enter a move, they don't do it all at once. They test the market's appetite. They allow the price to move through resistance, and then they watch how it reacts. If the stock holds strong, they add more. You, as a trader, should do the same. Buy your first portion when you see the breakout, but small. Then wait for the market to confirm your decision. If the stock continues to act right, higher highs, controlled reactions, volume following the trend, then you can add. That's the discipline that separates speculation from gambling. Gambling is hoping the move continues. Trading is verifying that it's real. In my time, I watched entire fortunes disappear because traders mistook excitement for opportunity. I saw men who made $1 million on paper in the morning and were wiped out by the close. They bought into breakouts that never became trends. And when the reaction came, they refused to admit they were wrong. That's another lesson. You must always be ready to admit when you're wrong immediately, without hesitation. The market gives you signs when your trade isn't working. Listen to them. When I say don't buy breakouts without proof, I mean protect yourself from your own emotions. Because every false breakout is powered by one thing: human psychology. People want to believe they're early to something big. They crave that validation, that feeling of being ahead of the crowd. But in the market, the crowd is the bait. When you see too many traders excited about a breakout, that's when you should start being cautious. The crowd never wins for long. I remember a stock back in the day, Union Pacific. It had been trading in a range for weeks. Everyone was talking about it, breaking out soon. The newspapers wrote about it. The chatter on the floor was deafening. I watched it climb to its resistance level, and as soon as it ticked above, traders jumped in like madmen, but there was no proof. The volume wasn't right, the reaction too sharp, the price action too forced. I waited. A few hours later, the price reversed violently, trapping everyone who chased the move. They panicked, sold in despair, and only then did the stock find genuine support. A week later, the real move began quietly, with steady volume and without excitement. That's when I entered, and it became one of my best trades that year. The lesson? The market doesn't reward noise. It rewards patience and precision. You see, the market has a rhythm. It's like the ocean. Waves come and go, but not every wave is worth riding. Some crash immediately, others build slowly and carry you far. If you try to jump on every swell, you'll drown in the chop. Wait for the proof, the confirmation that the tide is truly moving in your favor. Proof also means alignment. When I say alignment, I mean that the price, volume, and market conditions must all point in the same direction. A breakout in a weak market is like a candle flickering in the wind. It won't last. You need the wind at your back. That's why I always studied not just individual stocks, but the market as a whole. If the general market was in an uptrend, the odds of a breakout succeeding were much higher. But if the market was weak, even the best-looking setups would crumble. A trader who buys every breakout is a trader who believes he can outsmart the market. But the market is never wrong. Only the trader is. You must learn to operate with humility. My greatest losses came not from bad analysis, but from arrogance, the belief that my judgment was enough proof. It never is. The only proof that matters is what the market shows you. And when you get that proof, don't hesitate. That's the other side of the lesson. Many traders make the mistake of waiting too long after confirmation. They want to be absolutely sure, and by the time they act, the move is already extended. The market rewards decisiveness backed by evidence. Once you've tested the breakout, once the stock has proven itself by holding and acting right, then step in with confidence. Trading is a constant balance between patience and courage. Patience to wait for proof, courage to act when it appears. Most traders fail because they mix the two up. They're courageous when they should be patient, and patient when they should be courageous. You must think of the market as your teacher. It gives the same lessons again and again until you learn them. Every false breakout you chase, every time you buy hope instead of proof, you're paying tuition. Eventually, if you survive long enough, you'll stop trying to predict and start waiting to confirm. The proof isn't just technical, it's emotional. It's how you feel in the trade. When you buy too early, your stomach tightens, your thoughts start racing, and you watch every tick with anxiety. But when you wait for confirmation and the move is genuine, you feel calm. You know you're aligned with the market, not fighting it. That's how you should feel when you trade calm, methodical, almost detached. I used to say that the market never changes because human nature never changes. People today trade with computers, algorithms, and fancy tools, but the emotion is the same: fear and greed. They still chase breakouts, still panic at reactions, still look for shortcuts, but the principles haven't changed. Proof before profit, evidence before action. If you want to survive in this business, learn to think like a detective. You don't act on rumors, you wait for evidence. Watch the stock's behavior, not your own excitement. The tape tells the truth if you know how to read it. The patterns, the reactions, the quiet strength or weakness in the movements, all of it is information. The market whispers before it shouts. When you learn to wait for proof, something remarkable happens. You start trading less, but you win more. You avoid noise, you sidestep traps, and you let the market do the heavy lifting. That's the real secret behind consistent success, not predicting, but confirming. So the next time you see a breakout forming, ask yourself, is this proof, or is it just promise? Is the demand real, or is it just a rush of enthusiasm? Let the market answer. Don't force it. Because the difference between a professional and an amateur is that the professional waits for the market to prove him right, while the amateur tries to prove the market wrong. And in this game, the market always wins. So wait for the proof, then act with conviction. That's how you survive, that's how you grow, and that's how you make the kind of fortune that doesn't vanish overnight.